In the previous lecture, we saw what an at-the-money option was. In general, an at-the-money option is a strike price that is equal to or very close to the current fair market value of the asset or the stock. In this lecture, we're going to look at two other kinds of options. The first one we're going to look at is an out-of-the-money option. In this scenario, let's assume that the buyer is confident that the price of the house is going to go over $1.1 million in the next 60 days. Now, why is he so confident? It doesn't matter. This is just an example. So the buyer is confident that it's going to go over $1.1 million. So he wants an option to buy this house at the strike price of $1.1 million. So if you look at it from the seller's angle now, the seller is thrilled because he's obviously going to get a premium for this option. And plus, if at all he has an obligation to sell this house, he has an obligation to sell it at the higher strike price of $1.1 million. So it seems like he's going to get advantage from both of these factors. But what is the premium that he can charge for this option? Bear in mind that the previous example, the at-the-money option, costed $25,000. So what do you think is going to be the premium for this option, which has a strike price of $1.1 million? It obviously has to be lower because the price of the house has to go from $1 million to $1.1 million before this option can be profitable. So the price for this option is obviously going to be less. And let's say they agree that a reasonable premium for this option would be $10,000. So then the current price is $1 million. The strike price is $1.1 million. This is an out-of-the-money option. It's out of the money because the stock or the underlying asset is not profitable yet. It is still out of the money. So it has to move from $1 million to 1.1 before the option has any chance of profitability. But now we know that the break-even price for any option is the strike price plus the premium. So the break-even is actually 1.1 plus the $10,000, which makes it 1.11. So here's a great takeaway. Whenever you look at out-of-the-money options, they are always going to be cheaper. They're always going to be, and some of them will be really cheap. If you go further out of the money, they're going to be even cheaper. So, think of a $1.2 million option. It's obviously going to be much less than 10,000. It may be 2,000 or something. And there's a reason why it's less, because it has less probability, a less chance of success. And success is defined if the option can get to that strike price. So the ability of that asset to move and go hit this out of the money strike price is what defines its probability. So out of the money options are going to be cheaper, but they're also going to be less probable. Now we are going to look at a third scenario. The third scenario is an in-the-money option. So let's say now the buyer wants an option to buy the house at $800,000. Now the seller is absolutely confused because why would he give the buyer the right to buy the house at $800,000 when it's already worth $1 million? He thinks about it for a while and then he realizes that he must capture that extra $200,000 right now into the premium of that option. So after thinking about it, he quotes a premium of $225,000. Now, how did he come up with that? He looked at what the at-the-money option cost would be, premium would be, which is $25,000. And then he knows that he has to capture that extra $200,000 right now. And so he quotes $225,000 as the premium for this in-the-money option of $800,000 at $800,000. Now, this in-the-money option, it's already in the money because the value of the house has already gone higher than the strike price of the option. In fact, it has an intrinsic value of $200,000. This $200,000 is called the intrinsic value of this option. And the extrinsic or the time value is $25,000. This option is an in-the-money option. So there are two takeaways from here. In-the-money options have intrinsic value as well as extrinsic value. Extrinsic value is also called as time value. In-the-money options also have the highest probability of success, but they're also most expensive. Now, it should make intuitive sense. They have the highest probability of success. In fact, this option is already successful because it's already in the money. And because it's in the money already, you're going to have to pay a much higher price for this option. So those are the two takeaways about in the money options. In the money options have intrinsic value and extrinsic value. And in the money options also have the highest probability of success. In fact, at this point, they're already in the success zone. But if you wanted to buy this option, it's obviously going to be much more expensive because you're paying for intrinsic value. So that's as far as at the money, in the money, and out of the money options are concerned. But before we go further, I just want to recap the three different options because this is important. What do you think is the intrinsic and extrinsic value of our first option, which was at the money? So we're looking at the $1 million option. And then what do you think is the intrinsic and extrinsic values of the second option, which was out of the money? So we're looking at the $1.1 million option. If you think about it, it should become clear that the at the money option and the out of the money option have no intrinsic value. The at the money and out of the money options have only extrinsic or time value. Only in the money options have intrinsic value and extrinsic value. So what defines intrinsic and extrinsic? So let's say the value of the house went up from $1 million to $1,000,001. If it did that, then your at the money option would have an intrinsic value of $1. So anything above the strike price of the option is going to be intrinsic value as long as the house, the value of the house went up to that level by the day of expiry, on the day of expiry. So that's how you would look at these three different options. Now, what I want to do, we previously touched upon the buyer-seller profile. So we said that the risk-reward profile seems to be skewed towards the buyer. And I said, you need to hold this thought and we'll come back to it later. And I'm going to give you a little bit of more information right now. And some of this may or may not be very clear, but as you go along learning options, it's going to become very clear that the seller has some definite advantages in this deal, which may or may not be very obvious. So let's look at that. So seller has a few things going for him. Okay, so we're looking at the $1 million at the money option for which the buyer paid a premium of $25,000. The burden of price movement is on the buyer now because the fair value today is $1 million. And if it does not move higher to at least $1,025,000, then we as the buyer are at a loss. And this move must be made within the next 60 days. So that's another advantage to the seller because it's a limited time within which the buyer's option can become profitable. So time basically is working for the seller. So he benefits from time decay, what we call time decay. So as time decay is just as more and more time passes and the buyer's option is not profitable, the seller stands to benefit from such a situation. Probability is on the side of the seller because the break-even price is out of the money. So this is key. Right now, the at the money, the fair value is 1 million, but the break-even price is $1,025,000. So this break-even price is already out of the money. So probability is on the side of the seller because the price movement, the burden of price movement is on the buyer's position. And finally, the seller has some room to be wrong and still come out profitable. So let's see what this means. This is a very important characteristic of a seller's position. So let's say in the next 60 days, the house increased by $10,000 only. So the house increased by $10,000, and let's say the buyer, which is us, we exercised our right to buy. So we bought it at 1 million, and the current value is 1,010,000. But we've paid $25,000 as premium. So we, as a buyer, we are still at a loss of 15,000. So on the flip side, the seller has gained 15,000. Okay, so basically the seller still has some room to be wrong, and that room is between $1 million and $1,025,000. Whatever that the value of the house is, between that range, the seller still stands to make some kind of a profit from this situation. So these are all the factors that are working in favor of the seller. And as we go look more and more closely into the options world, into the real financial options, you're going to understand these features a lot better. In the next lecture, I want to cover the profit and loss profile as viewed on a risk graph. Now, risk graphs are something very important in all option strategies. And if you want to learn options, the risk graphs are absolutely necessary. So in the next lecture, I'm just going to cover the risk profile of the buyer and seller as we can view it on a trading platform. But we're going to look at just the graphs, the graphics for now, and then finally we'll be going over to the trading platform to look at real options.